Hey, how are you? Hope all of you are well. It's your CPA Manish here today on Sunday, the 26th of September 2021. And today we are going to take our discussion further into understanding what are the advantages of doing real estate. Before we move on with our discussion, the disclaimer being that this is not a legal or tax advice. This is only for your educational and entertainment purpose. And I hope you're enjoying the series. So let's discuss further. Okay. So in the previous video, we discussed why real estate is such an integral part of a lot of high net worth taxpayers' investment portfolio. We discussed why a lot of taxpayers like to have at least some part of real estate in their investment strategy. We discussed 3 advantages in that video. The first thing that we discussed is that real estate has a potential to generate tax-free cash flow. By way of example, we discussed that even if we have a cash flow from a real estate rental investment, in addition to all the expenses that we are able to write off, we are also able to write off depreciation. And because of depreciation, what happens is, even if you are generating cash flow month after month, year after year, because of this additional deduction of depreciation, your taxable amount becomes almost zero, and you're continually able to generate this cash flow on which you do not have to pay any tax for months and for years. It's an automatic cash flow, but you do not have to pay any taxes on that, right? Then the second dimension that we had discussed is that if you have mortgage on your real estate investment, you could potentially increase your rate of return exponentially. We discussed that if there is a delta between the returns that you are making and the rate of mortgage interest that you are paying, then we get to keep that delta for ourselves. And then we had to multiply that delta by the ratio of the equity we put in vis-a-vis the loan that we have taken. So one, you have a delta between the rate of return that you're generating and the mortgage interest you're paying to the bank. So you get to keep that delta. And then also there is a disparity between the equity you put in, maybe 25%, and the loan that you take, that is 75%. So that is a 1:3 ratio there. Or if you put in 20% and take 80% loan, there is 1:4 ratio there. So you have to multiply the delta by the ratio, and so much return could be increased or added in your rate of return. So you can exponentially increase your returns if you have mortgage on your real estate. So that was the second advantage. That was the second dimension we discussed in the last video. And then the third advantage we had discussed is appreciation in the value of your property. Even though you put in a portion of the value as your equity or down payment, you still get to keep the appreciation on the whole value of the property. So in our example, we had seen that even though we had put in only $250,000 out of the $1 million property that we had purchased, the appreciation was on the whole $1 million. So even though we put in a portion of it, we get to keep the appreciation on the whole value of the property. So that is another advantage. Even though we put in a part of the investment of our own money, we get to keep the appreciation on the whole thing, right? So we discussed these 3 advantages in that video. I hope you have watched that video. If not, I will keep that in the email that I sent to you today. And it might be a good idea for you to first watch that video and understand those 3 advantages so that we can move forward with today's discussion, okay? So let's move ahead with today's discussion. So moving forward, now what people do is after they have kept the property for a few years and they have been paying that mortgage mostly out of the rental income, and they have paid out some mortgage, and at the same time in few years hopefully the value of the property would have increased. So because of both these factors, that you have paid down some mortgage and at the same time the value of the property has appreciated a little, in few years you might be able to refinance your property. And it would be a cash out refinance. Cash out refinance means that when you refinance this time, you will be able to cash out some money more than the mortgage that you have on the property. So because you have paid down the mortgage and the value is appreciated, you now have created a delta. You have now created some excess equity in your property, which you can cash out if you refinance. So people would refinance the property after a few years because of these reasons. And then they will use this refinance money to make down payment on buying another property. So now they use refinance money to make down payment and they go ahead and buy a second property. Again, with the second property, we do the same three things that we discussed in the last video. On the second property, again, we will have tax-free cash flow. We will have cash flow, but not have to pay tax. We will also have exponential rate of return because of the mortgage delta and the ratio of mortgage that we have. And then we will also have appreciation on the whole value of property. We will do that in the second property. And again, in the second property, after a few years, there should be mortgage payoff and appreciation. You should again be able to refinance that, take that cash out, go to the third property, and so on and so forth. So you should be able to refinance and do second property and then third and so on, you know. So the only investment in our example so far that we have done is the down payment that we made on property number 1. After that, property number 2 and 3 and so on. In our example, we should be able to do that out of the refinance. It is an hypothetical example, but it is not an over-exaggeration. This is actually how the real life situation works. Okay, I hope you are with me so far. This was the 4th step in our life cycle of real estate that we are discussing. Okay. Now, we kept on taking the advantage and we kept on refinancing, and now we have multiple properties. And now let's say we decide to sell our first property. In our example, the first property that we had bought for $1 million, now we decide to sell after, say, 10 years. Okay. So now let's see what happens if we decide to sell the property after 10 years. So if you take a look at the screen, we bought this property for $1 million, and then we have been depreciating this property at $35,000 per year for last 10 years. So the depreciation is $350,000. And out of $1 million, if we take out depreciation of $350,000, our written down value, our net book value, our value of property as of today is down to $650,000. Okay. Now let's say we are selling this $650,000 property. Now let's say we need to sell one of the properties. Okay, let's assume that we are going to sell the original property that we had bought for $1 million, and that we are going to sell that property 10 years down the line. Okay, so what will happen is we bought that property for $1 million, and every year we have been depreciating that property at $35,000 per year. So in 10 years, we have depreciated it by $350,000. If you depreciate $1 million property in 10 years, $350,000, the current value of the property comes down to $650,000. So $650,000 is the current written down value current net value of your property as of today after 10 years. Okay. And let us assume we are able to sell the property for $1.4 million. The property has appreciated at 3.8% every year. And today the value of the property is, say, $1.4 million. So the property which is now valued down after depreciation at 650, if we are able to sell it at 1.4, then between 650 and 1.4, we are going to make a profit of $750,000. Okay, so that is where this profit of 750 comes from. Okay, so now when we sell this property for this profit, we will have to pay tax on this $750,000, right? Right? Yes and no. Yes and no. Let me explain. So if I sell this property and I do not do anything, then yes, you're right, I will have to pay tax on this $750,000. But then if I do something called as 1031 exchange, 1031 like kind exchange, then I can defer paying any taxes on that gain of $750,000 till I sell my second property. Let me explain how 1031 exchange works. So what happens in 1031 exchanges? If you are selling property number 1 and you're going to make gain on property number 1, if you take the sale proceeds of that property number 1 and you put all that sale proceeds into a second property of similar kind, into a second property which is again rental real estate, similar kind, then whatever gain you made on the sale of property number 1, you can defer paying any taxes on that sale. You can defer paying any taxes on that gain on that sale till now you sell the second property. You can defer till the point in time you decide to sell property number 2. Okay, that is how 1031 exchange works. So in our example, if we had this property which was down to 650 and we sold it for 1.4 million, and potentially there was a gain of 750, we could defer paying any tax on that $750,000. If we take this whole 1.4 million, that is our sale proceeds, and we buy a second property, similar kind of second property, rental property, for the whole $1.4 million, then I do not have to pay any taxes for now. I do not have to pay any taxes for now till I sell this second property now. Okay. Now, if I decide to sell property number 2, and on sale of property number 2, let's assume there is another $1 million of gain. Okay, now I decide to sell property number 2, and now I have $1 million of gain. Okay, plus remember the 750 from the first one is also going to come into picture. So when I sell property number 2 and I have $1 million of gain, I have to pay tax not only on the $1 million, but also on the 750 that I had deferred from the first sale. So I might have to pay tax on the gain of $1.75 million if I sell property number 2. But then what would I do? I would again do 1031 exchange. And again, all the sale proceeds from property number 2, I will put into buying a similar kind of property number 3. Okay. So now when I buy property number 3, I don't have to pay tax on that $1.75 million. The whole thing will get deferred till the point in time I sell property number 3, right? And then when I sell 3, I can do a 1031 exchange for property number 4 and then 5 and so on. So this is kind of a rinse and repeat kind of strategy. You can move from property 1 to property 2 and then from 2 to 3, 3 to 4, so on and so forth. And you can keep deferring. You can keep deferring paying any taxes on the gain till the point in time you keep on doing 1031 exchange. You can continue to do 1031 exchange as much as you want. That's how this 1031 exchange strategy works. Okay. But then what happens is, whenever you are at the final property, say you moved from 1 to 2 and 2 to 3 and 3 to 4 and 4 to 5, and you have been deferring and deferring and deferring. And then I'm at my final property. And if I sell my final property, then yes, all the gains that I have been deferring for so many years and on so many properties, all those multiple properties will all trigger at the same time. Okay. So say I'm on my 6th or 7th property, and now this property is worth $10 million. Okay. And this $10 million worth of property has come from my first $1 million property, which I kept on selling and deferring, selling and 1031 exchange, selling and deferring, selling and 1031 exchange. And that $1 million property has become $10 million today. Then the whole gain in between that I was deferring for so many years and over multiple transactions, that $9 million gain would trigger if I sell the property, if I sell the final property. Okay. That whole deferred gain would trigger if I sell the final property. Okay. But then I won't sell. I won't sell. Okay. Let me explain. This gains would trigger only if I sell the final property in my lifetime. These final built-in gains would trigger only if I sell the final property in my lifetime. So what I would do is I would not sell all these 1031 exchanged properties all my life till I die. I won't sell. If I sell, everything will trigger and I will have to pay tax, but I won't sell till I die, and I will let it pass on as my inheritance on my death to my beneficiaries. I won't sell in my lifetime. I will keep it, and I will let the final property pass on to my beneficiaries on my death. On my death, what will happen is, on my death, my beneficiaries will inherit this final property at what is called as stepped up basis. When I die, my beneficiaries will inherit my final property at what is called as stepped up basis. Stepped up basis simply means the value of the property on the date of death. Stepped up basis means the value of the property on the date of death. So in our example, the final property on the date of my death was worth $10 million. It was originally 1 million. We kept on doing deferring and 1031 and deferring and 1031. The final property, from property number 1, it went to 2, 3, 4, 5, 6, 7, whatever it was. The final property from that 1 million property became $10 million. And on that day when I die, my beneficiaries will get that final property at stepped up basis at the value on the date of my death. They will get it at a value of $10 million. And you know what happens? When they inherit the final property at $10 million, all the built-in gains, all the deferred gains which were in between that 1 million and 10 million, the whole $9 million, it is all exempted. It is all abated. You do not have to pay any tax on that $9 million. Okay, you see what happened? You see what happened? We started with getting a tax-free cash flow month after month, year after year, because of depreciation. Okay, so we bought one small property, we generated some good tax-free cash flow. We are very happy about it, right? Then because we had taken mortgage, we realized that there is a delta between our returns and mortgage interest multiplied by the ratio of our equity and the loan we had taken. So we were happy that our rate of returns was not only tax-free, it generated not only a good cash flow, but the returns were very good. Okay. Then we were happy that we are gaining appreciation not only on our equity investment, but on the whole value of the property. So that boosted our returns and we were happy and we were not paying tax all along. And then after a few years, when we saw that the mortgage has gone down, the value of property has gone up, we could refinance, take some money out and go to the second property, and third and fourth, we did refinancing and we did multiple properties. So we were happy with all the cash flow and no taxes and multiple properties being generated and all that. And then we got one good offer and we had to sell one of the properties, right? And on that sale, I might have to pay tax on capital gains. But then what we decided is it's a good deal, let's sell it, but we do not need to pay any taxes at this point. So we'll take the sale proceeds of that property, put it into another property and try to defer the taxes as much as we can, right? So we did 1031 exchange from one property to second, and maybe from second to third, third to fourth, and so on. So 1031 exchange was a good option. We did it for multiple properties, right? So we continued to do that. And then when we came to our final property, had I sold that property, I would have to pay taxes on all the deferred gains and built-in gains. So what we decided is not to sell the final property in our lifetime and let it pass to our beneficiaries at stepped up basis. And when our beneficiaries got that on stepped up value, all the accumulated gains, all those were abated and nobody had to pay any tax on those gains. So you see what happened. This was generating good income, good cash flow, tax-free cash flow year after year during the lifetime, and then also and then on the sale or 1031 or when it passed on to our beneficiaries. You see the whole life cycle, how the real estate thing works, right? Look, I tried to simplify my example, of course. It could be much more involved than the simple examples that I have put in the videos, but you get the gist of the matter. I wanted to show you how it works. Okay, so you get the gist of how it works. I know you are also thinking, please explain how 1031 exchange works. So I'll make a separate video on that. So you will have all the detailed information on how it works and what needs to be done. And most importantly, look, I'm not saying that real estate is all benefits and no drawbacks. Okay, like any other investment, this investment is as much risky and could be as much troublesome as anything else, right? So in real estate, also there are drawbacks. You might have to deal with few months of vacancy and you might not get good tenants. You might have to deal with hard-headed tenants. That's not good. You might have to do a lot of repairs and maintenance in your property. If the property that you bought is not up to your expectations and things like that. During pandemic, during last couple of years, even if the tenants did not pay us any rents, we were not able to evict them because of the moratorium. We had to allow to continue them in our properties even when they did not pay any rent to us. And there could be a lot of small and big hassles and problems dealing in real estate. So real estate could be as risky and with as much hassles like any other investment. So I'm not advocating for real estate being the best investment out there, but the intention of these videos is not really to focus on the drawbacks of real estate. My intention is to give you the reasons why people do this, okay, and bring some information to you which you otherwise might not know, okay? So that was the intention. And of course, real estate is not paper investment, right? It is a real estate. It's a real investment. Arguably, it has more asset protection than other assets. Arguably, it might not have as much volatility as much as other investments have. So yes, there are advantages, there are disadvantages, I just wanted to show you the whole life cycle to make you understand why this is so much attractive to so many people. You know, why Carnegie, um, the great Carnegie said that real estate is the way to make fortune. You know, so that these are the reasons why real estate is capable of bringing you uh, regular cash flow, not have to pay taxes year after year. So on an ongoing basis, it's a good investment during its lifetime. And then when you sell, you have 1031 exchange and stepped up basis. So it makes things even better, even after the life cycle, right? So there are very few investments that are good during their life and at that. This is one of them. So wanted to bring it to your attention. And yes, there are quite a few things that Biden administration is trying to limit, or Biden administration is trying to take out. They are trying to put brakes, and they are trying to put restrictions on how 1031 exchanges work, on how stepped-up bases are done. And if they get their way, then there would be quite a few restrictions on how things have been for so many years thus far. So as and when that happens, if at all that goes through, I will definitely come to you and give you an update on that. But for now, I hope you enjoyed both these videos on the advantages of real estate. Let me know if you have any follow-up questions or any afterthoughts or any comments. And in the next video, hopefully this time, we will jump on the question of using LLCs for real estate. Till then, take care, and I'll talk to you soon. Bye-bye.